Well, hello. Welcome to my studio here in fabulous Las Vegas. This is Dean Tenney. We've been explicating the content outlines of the FINRA exams and test specifications of the NASAA exams. And so this explication is on analytical methods. The first thing I would tell you about analytical methods is this is not make or break on your exam. 4 or 5 questions, I mean, they're there. I have dozens of practice questions in the 50 practice questions for you on 65, 66 on these concepts. I think if people struggle with them sometimes, it's because they're fearful of them, and so you just got to get past that. All right, so what's the time value of money concept? Well, basically what we say is that dollars today are worth more than the identical number of dollars in the future. So dollars today are worth more than dollars in the futures. How much more, or how less, but more, how much more, excuse me, is what we really want to be able to figure out. And so we want to talk about some of these concepts, the internal rate of return. For example, when you buy a bond, let's say I buy a bond for 90% of par, $900, and it has a 8% coupon. Let's say my yield to maturity on that bond is 9.5%. That 9.5% represents the internal rate of return from buying that bond today at 900 and holding it to maturity. So the yield to maturity concept is very similar to an internal rate of return calculation. Now, what we probably want to be able to do is turn that into some money, a dollar amount, and see what that is, that net present value of those future income streams. And we've come up with a price. For example, if I do a net present value calculation on a bond, remember this thing with the bond, we can go yield price or price yield on a bond, right? So I could talk about a bond's price, or I can talk about its yield. But if we take the net present value of a bond and we figure out what that number is today, let's say I come up with 940 is the net present value of those future income streams on the bond. Then I can mathematically say, okay, well, if I get it for less than that, that's going to be a good deal, or more than that, it's not going to be a good deal. In fact, I could actually come up with a number that I want to pay based on coming up with whatever the net present value calculation is. Now, most of the time on your exam, they're not going to make you calculate. It depends on your draw. I mean, I'm wishing for you a dream draw. Everything you studied shows up, but everyone's want you to face a death draw. And mainly what you have to do, in fact, let me get out my annotation tool, is a lot of times, instead of actually doing the math, what you've got to do is just recognize or be able to pick out that formula in a lineup. All right, so they'll show you some formulas and say which one of these is, the net present value calculation. So that more often than not, that's what you got to do. Now here we're going to work an example where, I'm going to have 50,000 in 5 years. I'm expecting a 10% return. What is the present value of that number today? So that's what we're going to figure out first in terms of doing this net present value. As I mentioned to you in a bond, we would set the net present value to 0. That's what internal rate of return is all about. But let's just take a look at the math that would be involved in figuring this formula out. As I mentioned, more often than not, what you're going to have to do is not actually do the formula, but actually just kind of recognize it. So we take our 50,000. By the way, on the test, you're always going to get 2 of the 3 things. So I highly recommend the practice questions I have for you. So they're either going to give you the internal rate, the number of compounding periods, 5 years. That'll always be given. The expected return will always be given. And then they're either going to give you the future value or present value. So that kind of sets you in the right direction of what they're asking you to do. So what they're asking you to do is actually either go future value to present value, which I'm doing now, or present value to future value. And again, I don't think they're going to have to do the math, just more of an illustration of what you're going to do. Now we're expecting in our example here, we're expecting 10%. So 1 plus 0.0. And then compounding period. Let's see if I'm going to be able to get my computer to do the compounding thing. Woohoo. And we're going to do that, right? And then we say, okay, that's going to give us our present value, whatever that number is, right? when we take the 50,000 and we divide that by when we do the compounding period, we find out that that's 1.61 051. And then when we do that math, we find out that the net present value is 31,046.07. Now, again, I would primarily want you to be able to do in this is just show you the formula, have you pick that out of a lineup. I'm not really interested in can you do that math in terms of passing your exam, but I do want you to be able to put that pick that out of there. I would like you to recognize that in total rate of return sets that net present value at 0. Let's put that there. Let's put that in a different color. And I've had that general understanding that I gave you about the yield to maturity is similar to IRR. We can do that calculation. All right, so moving on, descriptive statistics here. I put a sequence of numbers here to look at. And what I'd be interested in being able to do now, again, our time together is a buffet, but what I like to do is I like to sort the numbers out. So this could be the return of a mutual fund, the return of a stock, whatever the case is. Who cares? We're just talking about descriptive statistics in terms of a test issue. And so what I would do is I'd like to say, okay, well, I'm looking at these numbers. These are just given numbers again. So I just made these up. I like to say, okay, well, I got a negative 4%. I've got going from the negative number to the larger number, right? So I got a negative 4, and then I got a 3%. And then I have an 8%. And then I have another 8%. I'm just putting in some order that makes sense to me. And then I have 10%. So now I've just put those in a sequence that makes sense to me. Now, the mean is the simple average. The simple average. So let's put that here. Get a different color. I would be prepared on your test to do a simple average. Yeah, whether it's dollar cost averaging or, whatever it happens to be. That's what you're going to do. Now, if we add up all those numbers, if we add up negative 4, 3, 8, 8, and 10, we're going to end up with 25. So we're just simply going to sum those numbers. So negative 4, negative 4. We got plus 3. We got plus 8. Plus 3. Plus 8. Plus 8. Plus 10. And if we sum those numbers, we end up with 25. And then we simply, to get this simple average, just divide that by the number of occurrences, and we get the mean here of 5. I would be able to do that on your exam, whether it's dollar cost average. At some point, you're going to have to get simple average of something. So, I'd be able to do that math. The median is the middle number. I'm trying to put that in different colors here. Yeah, and that's one of the reasons I told you what I would do is look at the middle number, which is going to be the 8, right? We got negative 4, 3, 8, 8, and that's the middle number. And so in our example, the middle number is going to be 8. The mode is the number that occurs most often. And again, what I'm simply trying to do here is put in a different color, the stuff that I'm adding to this. By the way, I cleaned up the PDF that NASA provides to make our annotation a little nicer, but it's the same document. I highly recommend you print the PDF, have it as you're studying, have it as you're going through these explications with me. If you have any questions, put them in the comment box and I answer pretty quickly. But you also want to use this as your own intellectual inventory, the PDF that NASA provides. If it's not on the PDF, they're not allowed to ask it. I mean, it's, if it is on the PDF, then they are allowed to ask it. As we said, the medium is the middle number. The mode is the number that occurs most often. And here in our sequence, I just made up our mode. The number that occurs most often is 8. And the range, is the difference between the two. The difference between those two numbers. From small to high. I kind of think of it as a thermometer. I'm teaching series 3. When I'm trying to get people to understand this, what I usually use is the thermometer. And so, if we were in -4 degrees, so the range is the difference between the lowest, let's first put our definition in there, the difference between the lowest number and the highest number. And here, that would be -4 to 10. And so the range here was 14. And the way I think of it is we went from 4 below 0 on our thermometer to, 10 degrees above 0 on a thermometer. We've actually increased 14 degrees. It's warmed up 14 degrees. So you live in a place like, Minneapolis, maybe that's a heat wave. So, all right. So what's our next one here? There were 4 or 5 questions on this stuff. Our next one here is standard deviation. Not going to make you do any math on standard deviation, but one thing I would want you to understand is if you understand these formulas, and again, I have some practice questions for you. Standard deviation, you can distinguish that between alpha and beta. And one of the ways you can distinguish that is because you can say, well, gee, it doesn't have anything to do with the market as a whole, where if it's an alpha or beta or something like that, there's got to be something in the question about that. But what the standard deviation does is measure the level of risk or volatility of an asset. Let me fix that. And how widely spread or is that volatility? When I show you a chart, of a standard deviation, I'd say, well, listen, this is unlikely to occur. Sometimes I see people misusing statistics, like to say this is a 1,000-year flood. Just means standard deviation says that shouldn't happen. That would be the tail end of that. If you're not a math person, I would know that 1 standard deviation, let's just put a measurement here. 1 standard deviation. Oh, sorry, let me get a different color again. 1 standard deviation means that the dispersal volatility will be within those, whatever those 2 numbers we establish are, 67% of the time. And 2 standard deviations means it would be within that 92% of the time, that dispersal, that volatility. I usually, when I'm teaching class, use apples. Say, look, if we looked at standard deviation on an apple, 92% of the time, it's going to be between 100 and 150, whatever the math shows us, right? And then some things will be more volatile than other things when we do that math. So 2 standard deviations means it will be there within 92% of the time. I don't like the way, one of the challenges on NASA's, there's really just no flow with NASA. I mean, for me, I'd probably talk about beta before I actually talk about alpha, because beta test question, beta is a measurement of a stock or bond or stock or mutual funds volatility as compared to the market as a whole. So, it's part of the capital asset pricing model, which we'll talk about in a future explication. But for right now, let's just put that there. We'll do beta first and we'll circle back. It is a measurement of a stock or, funds, mutual fund volatility as compared to the market as a whole. I don't know of any draw where you don't get to ask something about beta as that relates. So a beta would mean twice as well as the underlying market. The beta of an S&P 500 track fund would be 1, whatever the market does, that's what it does. And that's what we would expect. Now, if I prided myself, I guess, as a money manager, I might say, well, listen, so what that the market went up, 13%. And I got you 13%. There was no added value that you could have done that in an index fund because that's what the market returned. But, level of risk, I might need to go a little faster to get where you're going. And so I would use beta to do that. So alpha is the return. Let's first put that in there. So let's put that. Let's get a different color here. I think of alpha as the returns in excess of beta. And let's just put excess returns in terms of the market. So here, I just want to give you a little example of alpha. And so we say a stock has a beta 1.4. That means it's 1.4 times more volatile than the market. And then we say that we have the market has returned 13%. The actual return was 9%. And we say that the risk-free rate of return is 3%. And so the way we're going to do that, let's get a different color here. Sometimes people miss questions because we can assume whatever risk-free rate of return we want. Some people use treasury notes, some people use T-bills, but it's given information here is 3%. So my point is, don't get too hung up on that. All right, so here our market return, was 13%. Let me get a different color. So 13%. Let me put in parentheses just to match it up. Our risk-free rate of return was given information that was 3%. And then we're going to times that by the beta. And the beta here was 1.4. And so when we do the 1.13 minus 3 times 1.4, we're expecting a 14% return. So as your money manager, I might say, well, why are you going to pay me for that? And, if alpha would be what I can get in excess of that. So as you see here, boom, we did 19%. Let me get a different color again. We did 19%. And then we're just going to back out what the market, we thought the market was going to give us, right? So we got 19 minus what we could have got for not playing, which was the 3% risk-free return. That's what you get for not playing. So that means we got 16. And we were expecting to get 14. And so here we have positive alpha. We actually have 2% in alpha. So as your money manager, I say, hey, listen, I did return to us 2% in positive alpha. And again, I wouldn't get too hung up on the math as much as the general kind of understanding or takeaway from these issues on your exam. All right, so let's just review some of the. By the way, remember just 4 or 5. So I'm unfortunately got to show you a lot more because who knows which ones you're going to get. So we're talking about analytical methods, 4 or 5 questions. We're talking about time value of money. We said the internal rate of return. We set that back to 0 for internal rate of return, and we said in a bond that's going to be yield to maturity. Oh, looks like I need to fix that up. Set to 0. Similar, and then what I meant to say there, it looks like I messed up. Bonds, yield to maturity is similar to the IRR, and we said you can do the net present value calculation to determine whether the bond is a good deal at the price. We set net present value to 940, and we can get it for less than that. That's a good deal based on our math, or higher than not such a good deal. I gave you an example. I told you I want you mainly to be able to pick out that formula. Not so much can you do it. You're getting a simple function calculator, so that's not really what we're interested in. But I would want you to be able to pick out that formula. But I did give you an example here of a present value calculation. 50,000 in 5 years is not as valuable as X number of dollars today. And so, as we said, you're always going to get as a given the years, the time, and you're always going to get the expected return. And you're either going to get the present value or the future value. Here you were given the future value, so we're going to go for the present value, which is a little lower number. Sometimes that alone can do it for you. Here we said that we're expecting 50,000 in 5 years, and we can get a 10% return. So if we can get a 10% return, what is 50 grand worth today? And so we plug it into our formula, and we say, assuming we can get 10%, 50,000 5 years from today would be 31,000. $47.07. And then we talked about descriptive statistics. I just made up a series of numbers, 10%, -4, 8, 3, 8. This could be the return of a fund. It could be a stock, who cares? We said that descriptive statistics means you're going to have to know the mean or simple average. That's testable. And somehow, some way, I said you're going to have to do that. And we said the mean is the simple average, and we just totaled up the numbers. We divided by 5, we got our mean. We said the medium is the middle number. I think of the medium on the freeway, right? The medium is what separates, the northbound and southbound lanes, or east or westbound lanes. Stay off the median, right? We said the mode is the number that occurs most often. By the way, I showed you the math here, but I would just, this is good flashcard fodder. Just make sure you know which one's which, right? They could just put that in an answer set and ask you which one's which. And we said the range is the difference between the lowest number and the highest number. And we said standard deviation is the dispersal of the numbers between a level of risk and volatility of an asset. And, the wider that dispersal is, the more risk that's going to have, right? And we just talked about one standard deviation being 67% and 2 standard deviations being 92%. That's where we would see the pattern in terms of the price movement of in volatility. We said alpha is excess return. Seeking Alpha, that's a big website that people go to, Seeking Alpha. So that's excess returns. I mean, the point here again is we shouldn't be getting too much. I don't know, I shouldn't say too much, it get prejudicial, but seeking alpha means I want excess returns. I'm going to take risks to do so. But we have certain expectations based on the beta. We said beta is very, very testable. Beta is a measurement of a stock or fund's volatility as compared to the market as a whole. And alpha would be that excess return. And so here I showed you an example of a stock that had a beta of 1.4, meaning it's 1.4 times more volatile than the market. Now, remember that goes both ways, up or down, right? The market returned 13%. We've got a 19% return, and we assume the risk-free rate of return is 3%. Remember, we assume whatever that number is. So we are making some assumptions when doing math. So to figure out the alpha, we took the 13% that the market gave us. We took the risk-free rate of return. I think a risk-free rate of return is what you get for not playing, right? So I didn't need to risk my capital to get 3%. So we were expecting, based on beta, to get a 14% return. We actually got 19%. And again, we're going to back out what we could have bought, T-bills or T-notes or whatever we used as our risk-free rate of return. And so we got 16, we were expecting 14. So I feel pretty good. We got 2% and positive alpha. So pretty cool. Sharp ratio, Sharp ratio. I'm not going to make you do anything with the Sharp ratio, but again, it comes down to, comparing asset manager perhaps. And I say, well, listen, I'm not really willing to admit that guy did a better job than me. I mean, what level of risk did he take to get you that level of return? So the Sharpe ratio is a financial metric. Again, I'm not going to make you do it. I'm just going to ask you to do it. And this involves the standard deviation, risk-free and standard deviation. And what I'm saying is, did I deliver the same return to you without taking the risk? And, so two portfolios, the one with the higher Sharpe ratio, that's the test question, by the way, is just higher Sharpe ratio is good. I mean, I got a return without taking all the risk that maybe my competitor took, for example. So higher, let's just put that higher Sharpe ratio is good. Correlation. I don't know of any draw on your exam where you're not going to get a question about negative correlation. So, good news, I guess, or bad news, depending on whether you like this section. We said in this entire section, there's 4 or 5 questions, and we do know a couple of them. And so that by process of elimination, we can decide, well, how important are the rest of them, right? But negative correlation means things that go opposite directions. Yeah, let's, I guess, start with positive. Positive's not the test question, negative is, but positive correlation means two assets that move in the same direction. The one I usually use in class is, Ford and GM. I mean, for all intents and purposes, right? If you have Ford in your portfolio already and I buy you GM, I haven't really diversified you at all because those two securities have the same correlation. They move in the same direction. No correlation means there's no discernible pattern. I wouldn't worry about that. And then, as I mentioned, I'll get a, let's see here. There we go. I'll put this in caps because this is definitely something you got to be able to have an understanding of. There's no draw in which this concept is not going to come up. Now, this may not be true, but for test purposes, right? You're fantasy test fantasy land. For example, we might put some gold in your portfolio, thinking precious metals are going to have negative correlation to financial assets, right? Or we might use real estate for negative correlation. So I could say to you, well, listen, I added this to your portfolio because if the other things go down, this thing goes up. This asset goes up. Now, usually what they do is they show you an answer set and ask you to pick out which one would provide the additional diversification and what you'll be looking for. And they'll give you the correlation number and ask you to pick it, or they'll ask you to pick the asset class more likely to have a negative correlation. So that is certainly one of the 4 or 5 that you're going to find in this section on your exam. P.S. This is going to be in the 65 playlist and the 65, 66 playlist. The PDF here is exactly the same in this area. So just so you know, don't freak out. It says series 66 if you're watching this in the 65 playlist, because I put it right in the section it belongs into in that PDF. So there's no difference between the two. So please don't freak out. Don't start sending me all kinds of emails. Say, hey, Dean, I'm looking at this thing. It says 66. I'm a 65. The analytical tools here that we're using are the same on both exams, same number of questions, the same exact test concepts. So I'm just not going to label this 65, 66. As you see here in the 66, this starts with economic factors because the people taking the 66 have a 7. My 65 candidates, as you know, your explication starts with economics. The assumption is 7's already had that. So you start with the economics, which I've already explicated for you. financial reporting, which I've already explicated for you. And then the third section is what we're doing now in your playlist. For 66s, this is the first part of their explication. So that'll make any sense, send me an email or put it in the comment box, and I'll try again to make some sense for you. All right, so now we're on to ratios, financial ratios and their uses again, and same thing. So we said 4 or 5 here in our exam. I provided some ledger entries here so we could go over these questions together. So I provided a company balance sheet, and I stipulated it has current assets of 40 million. It has, of that $40 million in current assets, it has 20 million in inventory. It has current liabilities of 10. So I just stipulated that. And so the current ratio is going to be, by the way, it doesn't show up in the NASAA test specifications here, but I would know working capital. It's testable. It's just not in this area of the PDF that we're explicating. But working capital is current assets minus current liabilities. Current ratio is current assets divided by current liabilities. And so in the ledger entries I've provided here, it'd be 40 million divided by 10 million. And we find out it's 4 to 1. Quick ratio. We don't want to have to sell out for inventory to pay bills. So the quick assets, so, to do quick ratio, this is also known, let's just put that, this is also known as acid test ratio. So quick or acid test ratio. And to get this, we're going to take the quick assets. Oops, sorry, I'm going to get a different color here for you. And we're going to divide by the current liabilities. And the quick assets doesn't count the inventory. So, here we would toss out the inventory. We said, well, we have 40 million in current assets, but, acid test quick, we don't want to have to turn inventory into cash quickly. So we're going to toss out that. And that means we have quick assets of 20 million. That's the current less the inventory. We divide by 10 million. And we find out that's 2 to 1. So we have $2 in every asset for every dollar we owe. So that's not too bad. Debt to equity. I stipulated here that the company has long-term debt of 40 million. That's bonds, long-term bonds that have been issued. It has shareholder equity of 50 million. And so I have stipulated this company has total capitalization, because we capitalize a company with equity and debt. Total capitalization of 90 million. Now, what we want to do here is see how much of that 90 million belongs to our creditors, our bondholders. So we're going to take the debt and we're going to divide it by total cap. This one's kind of confusing because it says it's debt to equity, but it's actually debt divided by total capitalization. And so in our example, that would be 50 million divided by 90 million. And we get here, where's my calculator? 50 divided by 90. We find out that 55 cents of every dollar belongs to our bondholders. This is a solvency one here. So this is about the solvency of the corporation, whether they may go bankrupt or not. And these up here are about liquidity. All right, valuation ratios. I can't imagine any draw in which you're not going to get asked to do price to earnings or understand it as something to make comparisons amongst companies. And so I gave you an example here of a company that has a price of 48. By the way, the vast majority of the test is division. So if you can't decide what to do, hit the divide key. And so you simply take 48, divide by 4, and you would tell me the price to earnings is 12. It takes us 12 years in earnings to get back what we just paid in price. This is another one I can't imagine you're not going to get. So we said there's 4 or 5 questions here. We know we're going to get the PE ratio. We know we're getting that. And we know we're getting negative correlation for sure. So that takes care of, 2 of those 5, right? So, when you're trying to decide how much time to devote to this stuff. I haven't had anybody in years tell me they had to do or you saw anything about price to book. But as a value investor, if I'm looking for a margin of safety, perhaps I want to buy a company close to price to book. Book represents the liquidation value of the corporation. We don't suppose we're going to do that, but I mean, it gives me a margin of safety to say the business can be liquidated for X number of dollars. So, if it was price, by the way, we expect the corporation would have a price of its stock that's higher than its book, because if not, somebody's going to try and liquidate. Okay, so I hope you're finding these explications helpful. Please let me know because, as I started these explications, I said, if nobody likes them, we'll just hit the delete button and we'll stop. But we have completed the SIE. We're getting close to completing the explication on the 7. We haven't started the 6. I feel sorry for my Series 6 folks. That'll be probably last, unfortunately. We have started the 65. This will make the second installment on that explication. And 66 is this will make your first installment on your explication. So we're getting there. We're getting there. There's other content for 65, 66, but I recognize that we need more. And so I will continue to build up this content for you on the YouTube channel. Like, subscribe, and as I said, put in the comments or questions you have in the comment box, and I'll see you for the next explication. Please let me know if you find it helpful. Test date. I don't agree to do the publishing schedule based on people's test date, but if you're a loyal YouTube subscriber and you interact with me, there's a guy I know testing Wednesday. I'm trying to get some more stuff out to him before then. So